as I've done many times in my videos, which is when we look at the JOLTS job openings numbers, we are now kind of normalizing back to pre-pandemic levels. And so is this crashing? Well, it is certainly trending lower. And this is where, again, I do think that the Fed is probably likely to start cutting interest rates at some point here. This is starting to, or trending down. We do eventually want to see that trend slow, but we're still kind of at pre-pandemic levels, give or take. So to me, this is not a nightmarish story either. JOLTS job openings have been trending down, and actually in the recent reported one, we actually got a better than expected number. So again, when we're looking at the JOLTS job openings, yes, it's cooling, but it's not crashing. And that's the difference that I want to show you guys. The other thing is we can see the demand for labor in the form of our wage growth statistics. How are these looking at? Well, they're holding up pretty well. We have not seen a big drop off in average hourly earnings growth, right? So the growth, the average or hourly earnings growth in America, for the most part, has remained pretty strong. The demand for labor is still there. We're not seeing a dramatic drop off in this chart, and that is important for us to register. So again, if you want to call for big doomsday recession, I would just suggest that, okay, be attentive to the data. Don't just assume it's going to crash out. Look at what it's showing you day to day, week to week, month to month, and you'll be way better off, right? That's the important thing that we want to keep an eye on when it comes to this stuff. So for the labor market component of this, I would say things are holding up decently well. Is it immaculate? No. Is it terrible? No. It's kind of just holding in there decently well. And I think that that is where we could see the soft landing scenario continue to stabilize over time. Now, again, if we take a look at inflation data, and this is the other half, the CPI report has been consistently lower than expectations. Now, I wouldn't have given you this expectation, right? But this is why I think predictions you have to be careful with them. I would not have said to you that, okay, markets are going to see tariffs down the line and they're going to freak out. And I would imagine inflation is going to start to tick up. Well, in actual terms, again, we're data focused here. The red line is expectations. The blue bar is what actually showed up. We've had 4 reports in a row of inflation coming down or coming in less than what the analyst community was calling for. So the smart guys out there have been incorrectly assuming inflation was going to go up more than it did. And it just has not really materialized. Now, again, this is why we encourage, when we're talking about this data, to keep an eye on this. This is why we look at it every day, because this could start to change. We could get inflation starting to spike up. But again, the way that I do my stuff here is I'm reactive. I'm not predictive, because I can't predict with certainty what the inflation targets are going to be. But the market seems to think it can, and I can kind of play the other side to that. It's similar to, and you guys will hear from Chris Pulver in a little bit, it's kind of like implied volatility typically expects more volatility than actually appears in markets, hence why there's a slight edge in kind of being an option seller. The market, historically, the people tend to expect bigger moves than actually occur. Well, same thing in the tariff stuff. I think people overhyped or over-feared, I suppose, what could happen. Now, again, something could change, something could collapse. I'm not saying that those things are completely invalid, but the market has a tendency here to overreact and freak out. And so I think that right now things are relatively intact. We have the producer price index. We've had some cooling inflation on this side of things as well. Core CPI month over month, we've had several lower than expected readings here. PCE, this is another preferred measurement of the Fed, you can see has been trending down. This is a tailwind for markets. Having cooler inflation stories is a tailwind for markets. And so let me just jump back to my presentation here, make sure I'm staying on track. Where's my, here it is. So if I pull this back up here for a second and just hit present, let me make sure I'm on track here. Our next section is, whether or not, as we just got done discussing some of the data, right? How does all that look? The next question is, ultimately, what is the Fed going to do with this? What are the probabilities that we're going to cut interest rates this year? Is the Fed's policy currently restrictive? Why does the Fed not cut interest rates right now? Well, we discussed preemptive cutting could be problematic, right? If you cut interest rates too soon, that can be a problem. If you cut interest rates too late, that also can be a problem. And so, of course, the political regime, the Trump administration is pounding the table. You're going to be too late. You're going to be too late. But whether you're Republican or Democrat, that doesn't usually change. Policymakers or politicians always want the Federal Reserve to cut interest rates because it always makes them look better when people can go borrow at lower costs. Now, God forbid, you do that and it causes the national debt to skyrocket because, inflation gets out of control. And then we've got this whole nother round. That's where, the Fed is trying to navigate the ship through murky waters, stormy waters, right? You have, on one hand, if you cut interest rates too soon, inflation could come roaring back. And if you cut interest rates too late, you could send us into a recession and be behind the curve, is what they call that. So when we talk about the Fed rate cut probabilities, I do think that this year you're likely to get a couple rate cuts. I think that's the consensus on Wall Street is you're going to get 2. I think we could get 2 or even 3 cuts. I'm kind of like 2.5 rate cuts this year. That's my baseline because I see economic data cooling. We see PMIs. We didn't get into that, but PMIs cooling. So there is some expectation of slowdown in the economy. We also see jobs data starting to, it's cooling. It's not crashing, it's cooling. And at the same time, inflation has really made substantial progress. And that tariff stuff, which is concerning to the Fed as well, has recently, we've seen things improve, right? The worst case scenarios, the 145% Trump tariffs on China, seem to be in the rearview mirror now. And so I look at that and I say, okay, that's not, likely to be the case. And I imagine that the Fed is thinking that way too. They don't necessarily have to love or hate the tariffs, but at least they know they're not going to get the worst case. And so I think that sets us up for a second half where rate cuts are on the table, tax cuts. So again, or tax cuts from the administration, the more positive perceived side of things from the administration, as in retrospect to or in response to the tariff side, right? We talked about the positives versus the negatives and things that we want to look at. I also think it's worth just taking a quick look at some of the current market sentiment tools that we can look at to get an idea of how things are playing out here. So if I go back to the Edge Finder here, and we now navigate just quickly to our overall sentiment indicators, I wanted to show you a couple things that we could look at. So what's market crowd sentiment out there like? Well, despite the bounce back, we do still see a pretty good bit of pessimism out there in this market. And we know an old adage in the market is that the stock market has a tendency to climb the wall of worry in a weird way. When everybody expects the market to go down, the market has this crazy ability to find a way to go up anyways. And when everybody thinks the market's just going to melt up into the sunset and it's going to go to the moon, it has a tendency to find a way to disappoint investors. It's not designed for the masses to make money. That's a weird thing in markets, but it's how it works, right? It's made for the minority of people who are, out there on the right side of the market moves to make money. And most people, unfortunately, are just not on that side very consistently. And so when we take a look at the S&P 500's put to call ratio, this shows us that sentiment is still mostly more negative than it is positive, at least on the put to call ratio. I would say, though, we're still in neutral territory because we haven't crossed the high put demand threshold or the high call demand threshold. We're kind of somewhere in the middle, at least right now. Take a look at the AAII Investor Sentiment Survey, and we can see that sentiment has been improving. The bearish percentage here was super high during all of the craziness. And again, I've been doing this for a long time, and I imagine you're going to hear from Chris something similar. We've been doing this for a while. He's been doing it longer than I have. And when we look at this stuff, when you get everybody panicked, it is amazing. It is absolutely amazing how good the market is at convincing everyone to sell their whole portfolio at the bottom and to go all in at the top. It's a crazy simple concept, but most people mess it up because it actually is hard. When the markets are down and everyone's panicking, it is hard to sell cash secured puts, to buy stocks you like, to have some sort of optimism in a market that is terrified. It's very difficult to do. It's easy to be bullish on markets when they're going straight up. So here's the thing, right? Sentiment is now, I would say, kind of back to neutral. So I want to watch these indicators going into the second half of the year. If you get stuff starting to get frothy, if we see a melt up through those highs, right? If the S&P 500 takes out those previous all-time highs, if we start ripping through on the S&P 500, then yes, I think you want to be careful. I think you want to be, cautious. And this is how I can't tell you what to do. This is not financial advice. As always, I'm just sharing my presentation and thoughts here. As always, I appreciate you being here, but I want you to understand you got to make your own decisions. And we're big believers here at A1 Trading. It's all about sharing insights and education. But at the end of the day, if you're going to make it in trading, it's on you. So here's my thoughts. If we see the S&P 500 melt into the sunset, I am not going to be aggressively chasing that. Even though you've heard me talk on this presentation about how I am bullish on the S&P 500, I am bullish on the indices. I did not get bullish right here. I have been accumulating shares. I've done pretty well in 2025. I've had a good year. But I'm telling you that if we do melt through the highs, I'm going to hold on to stuff that I really like, but I'm going to do what we do regularly on these streams. It's a phrase that Chris and I like a lot. It's the word cautiously or the words cautiously optimistic, right? So when you get breakouts through the highs, by the time the markets have reached the highs and the masses are flooding back in, that is where I start to just sit back in my chair a little bit. I'm not punching the buy button. I'm not chasing everything. I'm sitting back and I'm saying, okay, most of the time I should have already been in. And if I'm not in, I'm sitting back, right? I'm not going to chase. I'm not going to be silly about it. But I do think that if you get a market melt up through the highs and sentiment starts to flip more extremely euphoric, at that point, what I would do is I'd look to sell covered calls on my own personal stocks that I don't want to hold forever. I would also pause on buying indices aggressively. And maybe if I'm looking at anything, I'd be looking at something else, like maybe gold, right? Gold's back to the all-time highs, but pulling back here. How does gold look for the second half of this year? Well, in some regards, I would say gold has a really positive potential in the second half, because when we take a look at our economic heat map, going back and kind of giving an overview of what we discussed, if we see the data continue to cool off, right? Inflation data continues to cool, and we see, for the US dollar, that is a bearish catalyst. If we get consumer price index, producer price index, if inflation continues to cool and the economy cools in any way, I think gold could continue to push higher on a weaker US dollar. If we take a look at gold here, we're sitting back at the all-time highs here. And the way I would approach this is I would say, okay, this is not something where I want to chase gold. This is something where I would be interested on bigger pullbacks as a bit of a hedge, especially if you got gold down in the second half and stocks ripping through the highs, then it would be an accumulation phase for me on gold. Meaning longer term, I'd be looking at some buys on gold if we got that sell-off. But I can't justify buying it at the highs unless we have a strong catalyst of dollar economic data coming in really soft and perhaps price action breaking through these previous highs. Maybe there's a trade setup for me on gold in that regard with a tight stop in case I'm wrong. But the story that I like bigger picture for gold would be a retracement buy where, again, the economy, we still see cooling inflation, but maybe the economy sees stock market melt up first. If we get a huge break through the highs and optimism resumes and things are good and we see trade deals and all that stuff, again, I think that we have room for that market to squeeze higher on all that stuff. But then as you get more and more euphoric, that's where I say, okay, this is where we book profits. This is where we kind of covered calls. This is where we just slow on the buying, right? So the timing of buying indices and gold is something that, to me, you don't want to be chasing when everyone else is already doing so. You kind of want to wait for those opportunities. So when it comes to let's go to our top setups page here for a second. And this is going to give me just a general viewpoint of how I'm seeing things in the second half of this year. So I do like oil as a second half of the year hedge. Oil and gold, I think actually have more upside in the second half of this year. Gold, I think, could consolidate. It's not like my top pick by any means, but commodities wise, US oil, I think, is trending higher. I think the economies are holding up in the world better than people thought. And the demand side for oil actually looks strong. So you're getting this big sell off. There's probably, I'm not keeping up with it as we do this presentation, but I imagine this is some sort of geopolitical announcement, some progression. Let's hope for all of our sakes when it comes to what's happening in the Middle East, that we get further peace progression just from a humanitarian standpoint. As always, that's the policy of the channel. We don't want to bet necessarily on or wanting to profit off of something horrible happening in the Middle East, but we do need to think about it from a portfolio perspective. Could I add some oil as a hedge here? I really like the idea of getting long oil. If we get a pullback to like the 61.8% retracement, we've had this big move higher, beautiful push, right? And adding it in as a hedge in my portfolio is not something I'm too worried about. Just to get into stocks for just a second, I'd probably be looking to buy energy stocks if we got a dip in energy stocks. I like the idea of spreading out my portfolio, not just being all Mag 7, right? When I say Mag 7 for the newbies in stock world, talking about Amazon, Apple, Google, Nvidia, things like that. So I want to spread out in the second half. Now, that brings me to another part of the market that I like, which is the Russell. The Russell, is a very much a kind of broad index of small companies in the United States. I'm currently long the Russell, but I also like most of the indices. So when we take a look at the S&P 500, the Nasdaq, I've mentioned that I am bullish on these things, but when I say bullish and I reiterate cautious optimism on these things, I'm not saying I'm buying massive out of the money call options on the SPY. I'm not doing any of that. I'm talking about buying selective companies that I really like, or buying the index on retracements, right? That I think give you a better risk to reward profile. So on this Russell trade, I of course I can pat myself on the back here for a trade that I'm already in, but I caught this thing on a pullback. It went well, and I'm trailing a stop loss and would like to continue to doing that. I'm not long the Nasdaq. So here's an example: if we get the Nasdaq rolling over for a couple days, couple weeks, right? Then we're looking at a story where, okay, I could be buying that dip with expectations. I think most likely we see new highs this year. And so that gives me a better risk to reward. But right now we're not, new highs this year is hardly saying anything when you're 1.3% away. If you get 5-6% pullbacks before then your risk to reward profile becomes really good. So the way I'm viewing indices at this time is bullish, but only adding if we get proper pullbacks. I can't justify chasing this thing. I can't justify adding a whole bunch of NAS longs at this moment. I'm long the Russell, so I'm already exposed. I bought a bunch of stocks earlier in this year in the April sell-off. We talked a lot about that on the show, buying a lot of stocks that I'd liked for the long term in that dip, despite the scary headlines. But in terms of where we are now for the second half, I am bullish on the indices, but waiting creatively or patiently for better opportunities to pick them up on the long side if we can get that. Like I said, with gold, I do like the idea of having it in the portfolio alongside oil as a hedge, but would need to see pullbacks and kind of the story to weaken a little bit for gold. That would actually give me a better risk reward profile on buying it personally. So there's something to think about. Let's move on now to currencies. So if we talk about the dollar index, where are we at? Dollar index is continuing to push lower. Now, when we talk about the dollar index, this has been a theme in 2025. You want to talk about one of the cleanest examples of a trend that's occurred in 2025? Look no further than the US dollar. The Trump administration, with their trade, trauma and all the deals and stuff that are supposedly coming in, all this stuff, the market as a whole has pretty much sold America in terms of a lot of assets this year. Now the stock market has come back. But the US dollar has not. We have not seen the return to strength of the US dollar. In fact, we are back down to almost fresh lows for 2025. Do I expect that to occur or to continue in the second half of this year? Well, the answer is most likely, I think that the path of least resistance for the dollar index is to continue to the downside this year. Now, again, I mentioned I expect rate cuts this year. I think rate cuts are likely coming down the pipeline. I also think that there's a little bit of, if I'm another country and all this stuff, I'm probably saying if I'm another country that does trade, I would say we are really exposed to the US and I want to get rid of some US dollar stuff, right? I don't want to be so exposed to one guy in the White House, who you may like, who you may dislike, but the next guy might be crazier. You never know in this crazy time that we're living, right? You might get a more, now I don't mean to say as in Trump is just crazy. That's not what I'm saying. What I'm saying is the next president could do policies that more impact a country outside of the United States, right? So you can get these really, really volatile single people that, as another nation, you may not want all that exposure to the one person in the White House. So I think that there might be a continued kind of trend lower, some unfavorable moves for the US dollar. Not only that, but I do think that the US economy, the labor data, all that stuff that we got done discussing is still kind of pointed in the direction of a weaker dollar, at least for now. So I remain mostly bearish on the US dollar. Going into this year, I actually thought that the US dollar would be more neutral or sideways. I've been wrong about that. Dollar has been moving lower because, kind of no one really expected the trade war stuff to go, at least not me and many people that I know and listen to. It was kind of a out of left field how aggressive the tariff side of the Trump administration was. And so the dollar kind of continues to move lower. We're back down to the lows. Momentum seems to be to the downside for now. And we can turn to other currencies that have benefited from this. Who's a big beneficiary? The number 2 spot, the euro. Euro's done really well this year. Now, if we take a look at the European economic heat map too, something to notice here is that the euro, we've had some pretty good stocks impact data here. And I'm actually long the DAX for this reason. I picked up the DAX last week. Pulled back to a level of support. Many of you guys probably know exactly what I'm talking about. I can pull up the DAX. This is kind of a trade based on the economic data out of Europe, right? It's been relatively stronger than what analyst forecasts are. I'm not saying that the European economy is this shining example, but how have things been holding up? Well, the PMIs came in strong. GDP growth beat estimations, right? Employment change been okay. Unemployment rate stayed flat recently. Inflation's been cooling, giving the ECB the chance to cut interest rates. This is part of the reason why the euro is looking a little soft, is because inflation data suggests more rate cuts, but that's positive for stocks. So I like the DAX, right? So for that story there. So the euro itself, though, looks very, very strong in terms of momentum here against the US dollar. The British pound also looks strong. So my theme here is mostly short dollar, long other things. Now, from a long-term perspective, however, do I think the dollar has massive downside to go? The answer would be no. I do think that in the short run, perhaps for the next few months, the dollar index likely still has some negative headwinds. But if you take a long-term chart, you say, do you think the US economy is going to outperform other places? The dollar, the currency, should positively reflect that. So to me, most likely the dollar does continue to push lower, but on a longer term basis, I still think it is likely to stay as the reserve currency. And so on a longer term basis, maybe there's some opportunities to buy the dip on the dollar index. So it depends what your time horizon is. Super long term dollar index, if it really trends lower, I think that the straight up strengths of the two economies side by side, for the long term, I would actually favor the US dollar in most of these currency pairs. But in the short run, the economies of other places seem to have a little bit better of a layout for me personally in my own trading approach. So let me just make sure I go back to my presentation as I'm wrapping up here, because again, we do have Chris Pulver taking over part 2 of this. We talked about a little bit of the price action for most of our other things here. I'm going to skip the stocks component. By the way, I just kicked off a brand new stocks YouTube channel. If you're interested in specifically stocks, search up Trader Nick -stocks on YouTube, and you can find out some information about stocks that I'm watching. I've been doing a lot of coverage over there, but I'm going to skip this component just because we're running short on time. Talked about currencies, talked about the dollar, talked about commodities, talked about indices, and I hope that gave you guys a conceptual view of how we're looking here so far. Now, before I pass over the stream or the webinar session here to Chris Pulver, I wanted to just make sure that everybody who is here with us now is aware of the current VIP memberships discount that we're running. Now, if you just sat through everything that we just did together and you enjoyed the commentary and you feel like you jive with my style of analysis, both technical, fundamental, sentiment, all that stuff, if that was beneficial to you, then I want to invite you to come join our Discord VIP group. Now, I know that a lot of people are like, oh my gosh, he's selling a membership. He's selling a signal service. Absolutely, I am. But I can tell you that with the combined experience that Chris, myself, Alan, and Ivan bring to the table, I would honestly spend every penny and much more than what we charge to join the group to be a part of this if I could do all this over again. And I mean that hand on my heart. I genuinely mean that it would save me so much time and so much energy and so much money to have just joined a group like ours. Join our coaching calls, do more of this. We do that. We're doing this free, but you can come join the action, join the chat rooms, join the conversation. And even more than that, you can see the trades that we're taking with full context and breakdowns. So we just put a link in the chat. If you're watching the stream right now, if you're watching the webinar right now, we're going to offer 45% off our VIP memberships. It is a one-time payment to join the gold VIP membership for 45% off. I think it's less, it's like $380 or something like that, which is a super low price. If you think about this thing from a long-term perspective, if you see yourself trading over the long term, consider taking that offer while it is available. So again, if you'd like to trade with us, let me show you just a bit of context too about what the trade alerts look like within the group. So if you join, you'll be seeing every trade that I take. So I mentioned I went long the DAX, right? So I broke down why I'm buying the DAX, just like I'm doing in this webinar series right now. But instead of just conceptuals, you'll actually get my trade orders. So when I take a trade on the DAX, when I take a trade on the Russell, when I trade the euro dollar or the British pound or whatever, or gold or silver or oil, I trade a little bit of everything. You will get notified the exact entries, the exact exits, but more importantly than anything else, why the trade was taken, why the entry was where it was, why the stop loss was where it was, how I'm managing my risk with each and every position. If that would be something that you think would help level you up in your trading, I think it would too. And I would encourage you to take advantage of that discount while we offer it during this live stream event. Click this link, send us a message, let us know that you would like to join for that 45% off offer that we're doing. And we'd love to have some of you guys join the group. Like I said, I know a lot of people out there are like, oh, I don't want to spend any money, but I genuinely mean this. You will lose more money just chasing your tail in the financial markets than if you just invested in the proper education, the proper resources and tools to take you to that next level, rather than just running. Here's a non-affiliated plug here really quick. I also think people should buy a copy of FOREX Tester. It's a software that allows people to backtest way quicker, way more data. We don't have any kickback. We don't have an affiliate relationship with them in any way, shape, or form. But I think it's way better that people take their money. If you have an available budget of, I'm investing this budget in learning to trade, invest in a membership with whether it be ourselves or someone else that you like that has a style that you like. Take advantage of that. Get a Forex testing, back testing software or some sort of back testing. I know there's like options back testing if you're into that. There's all sorts of different back testing stuff. Invest your money there. Do not invest all your money into buying prop firm challenges when you don't have a proven model. That would be what I leave you here with in my presentation. Is I hope that you enjoyed the breakdown. If that was thorough, if it was helpful, the recording will be sent later to everyone who registered using the link. We'll drop the registration one last time, just in case you want to make sure you got the right email in there. We'll drop that in the chat. And like I said, if you'd like to take advantage of the 45% off sale that we're offering, you can see all the trades that I'm taking. And you can we also have that offer available for the Pulver alerts, which will be Chris Pulver's service that he also has within our Discord community. So guys, I've run out of time. I'm 2 minutes over. Up next, we have Chris Pulver joining the session here. Maybe instead of rolling a break, we can just jump in here and I'll say hey to Chris before he goes. Let's see, here he comes. Hey, Chris, how are you?
What's up, Nick? Morning, man.
I was saying at the beginning of this is kind of a fun series that we do. I view them as kind of like checkpoint moments where we're just talking about, we did one last year. We did one for the election and going into 2025, like setting up our game plan. We did one before that I know we did one with the trading zone with 8 cap. So I'm glad we're doing this. And I think it's a really important thing to kind of take a midway point, halfway point for 2025, because we've had a crazy year so far. And I do think that the landscape has changed dramatically from January till now. So without further ado, Chris, I'm going to give you the floor here to go through your own charts, your own presentations, and good luck with it.
Perfect. Thanks, Nick.
All right, man. See ya.
All right. Take care. Okay, everybody. Let me go ahead and jump into this. So I want to start off, like Nick did a fantastic job, as he always does. I wanted to have a little pop quiz today and see what does everybody think is your favorite tool? Actually, not favorite tool. What is the best tool that you have in the markets? Like, as anybody that wants to be a trader, aspiring trader, hoping to be a trader, what's actually your best tool and asset? Does anybody know? You might have to summon your like your investor cap from Benjamin Graham, Warren Buffett. But what do you think is the best tool? Let's see. Let's see what it's. I'm looking for the chat. So type it in the chat. What do you think? What's your best tool, your best asset in order to be a successful trader or investor? It's just one word, and it's only 4 letters. Okay, let's see if anybody can. I'm gonna make that super, super huge. Here we go. Past charts, I say your mind. Mine's pretty good there, Aaron. Fundamental says Lee. History says Soccer Boy. Risk, mind. All right, I've got everyone now in like the 4 letter words. Okay, how about this? Is that a fair tool? Why is this a fair tool? If we take advantage of time, you can make money in these markets. Okay. And when I say take advantage of time, it means you got to survive. You've got to find a way to survive these markets. Think about how much money has been made in the last 30 years. Anybody if you've been participating in the markets anywhere in the last 30 years, you've seen bull markets that have been pushing things to all-time highs, and it's done it for the last 30 years. You can go back to the 1970s and see the last 50 years of all-time highs. You can go back to the late 1920s and 30s and see through wars and through all these crazy things geopolitically, the market still finds a way to go higher. Time is your best friend. Okay. Now I know that not everybody has the time or the patience to look 5 years out, to look 10 years out. But I am telling you that as long as you don't make any fatal mistakes where you're taking on the type of risk to blow your account up in the first month of trading, the first several months of trading, just trying and taking on a huge risk of 10% of trade, look, trade small, give yourself time, and what you will have is a market that will show you opportunity after opportunity after opportunity. Right? This year has been insane. This year's been nuts. A lot of volatility still not really priced in. I think this market finds a way to maybe get back to all-time highs. I would hope. I mean, I get to these phases in the markets. Like right now, I'm like, if we don't have a pullback to let's say 5,900, 5,800, then something tells me it's broken. Like it's so cautiously bullish, and the market's still melting up higher. Like it doesn't care until it's going to break later. And so a couple of things that I mean, all this year it's been terrible sentiment after what happened in February, March, and April. We obviously had a nasty pullback. The market used it as an aggressive dip buying opportunity. We had an entire administration that pivoted as hard as I've ever seen. I mean, the message was so clear that austerity is going to be supported. We're going to, drain the swamp. We're going to cut government spending. We're going to fix the budget and fix the deficit. And, Elon Musk, one of the best entrepreneurs in the world, is now aligning with government. You've got major, your large cap mega tech gazillionaires are aligning with the government to fix things or invest in the US and be, AI. And it all looked great and optimistic on paper. But man, it pivoted hard, and it just reminds me of what happened in 2016. Everyone voted for Donald Trump to be, an outsider, and it's non-government. It's not the same old, it's not status quo. So it's very shake up the government, disrupt it. It's a snow globe effect. It happened again this year, right? What was the campaign that they ran on? Exactly what I said. We're going to shake things, and he had support. He had support for shaking up the government. Okay, but what did he lead with? Well, let's put on a global trade war and let's have mass deportation, as opposed to let's focus on growing. Let's focus on a better economy. Like anyway, it was a bait and switch. It was a lot of what the market didn't expect, and now the uncertainty is all over the place. But I go back to this: does the market care right now? It cared a lot in March. It cared a lot in April. But does it care right now? No, the market doesn't care. And now, we look at what is likely going to happen for the next probably year and a half. I mean, we're at this halfway point. There's all sorts of things that can happen, um, but the market just doesn't seem to care. I mean, I think by the end of the year, this market's either going to still be producing just single-digit gains, maybe eke out some positivity, showing that the U.S. is going to be out or underperforming compared to the world. I think that you'll still have, as long as the U.S. remains stable, non-U.S. assets will probably outperform this year, in my opinion. So I would say if it's a good year for the S&P, considering we were down, 20% from peak to trough, down almost 15, 16% for the year. I mean, if you look at where the year started, we had about a 14, 50% pullback. But from the all-time highs we had in February, we had about a 20% pullback in the S&P, 27% from the Nasdaq. All right. But it's time, right? If all this year is sideways, let's say that the S&P is up, net 5% for the year. My question is, do you have strategies that can still make money? Because I do. Okay. If the market's up for the year, if the market squeaks out 10% plus for the year, do we make money? Probably. It should be a lot easier. But I swear that if you are a perma bear, or if you get caught up in the narrative of how bad things are going to get, look, you can trade bad as a protective measure that offers a ridiculous amount of insurance. Okay, I have hedges on right now in my portfolio that might not pay me at all. At all, they might be just a worthless trade. Right, I'll lose 100% of what I put in these trades, but they can pay me up to 10 to 1 reward to risk. They can pay me up to 40 to 1 reward to risk. These hedges that I put in are they're huge insurance policies, and for a very little cost. And so I will sacrifice that cost as the market melts up. And as we've been talking, I mean, if you see me in these live sessions, I started out this year like off to a pretty good start. Um, and honestly, like I'm at highs, I'm at highs, I'm at highs. I'm still making money. I've been enjoying this little melt up, although I haven't been actively participating. I pulled a lot of profits out once we got through the big resistance areas that we saw in the S&P around that like 55, 5600 zone. I pulled a lot of profits because I was aggressively selling. I was like buying into this pullback and dip just based on scales. I mean, we dropped 10+%. I'm selling premium. We dropped 15 to 20%. I'm selling premium, right? And they worked out. And individual stocks have all performed well. We've seen, Broadcom hit all-time highs. We've had Netflix at all-time highs. We got Mag 7 stocks that have come back in a big way. One of the more hated, rotations that we've seen. So anyway, let me get into some of the slides here. There's a lot to unpack here, but I just want you to think about this. Time is your friend. If you can survive for the next year, let alone 5 or 10 years, you will give yourself countless opportunities to make money. Okay. All right. So let me go into a little bit of details here. Just kind of the review of what we've seen this year. Like I said, big pivot in the government, probably one of the more, I mean, I'm just going to say bipolar. I'm just going to say a bipolar market where everything started off with Trump, getting elected and coming into office, having support for this big government agenda to fix things, and basically we almost broke it. I mean, the basis trade blew up. The bond market flinched. It wasn't a break. We didn't have like a Liz Truss moment. We didn't have what happened in the UK markets back in September 2023. It wasn't that. It wasn't to that degree. But man, it was close. I think the financial markets flexed back real hard, and that's why we had such an aggressive pivot on April 9th. And here we are just watching like everything on the trade war side is quiet. We have not seen 130 some countries line up to do business with the US, right? What are we talking about right now? We celebrated, we're inking a deal with the UK. It's one of the only countries in the world we have a surplus with. We're negotiating with China. Are we? I mean, are we? And is it advantageous to us? Is it just we need to drip it out there and sprinkle it in like everything's fine in this side? Meanwhile, I mean, everyone's talking about the Fed is behind the curve right now. They're going to do something reactive. They're always reactive. I mean, everyone's so critical of the Fed, but they're never proactive. Okay. Last year was probably a misstep by the Fed by being proactive in September by cutting 50 basis points. I think they did it to kind of buy themselves the time just in case things got worse. Um, but we do have some interesting data points coming in, like continued jobless claims is starting to trend a little bit higher. Um, I think that if this market turns, let's say the market turns because our economy turns, unfortunately, I think that this turning point in 2025 or 2026, if we really head into a recession, I think it's going to be starting from the bottom up, right? So rather than the top, the wealthiest demographics, the markets, like everything that's just been floating on, kind of cloud nine the last couple of years in these big bull market conditions, I think we start from the bottom. So people that are living paycheck to paycheck, people that are struggling, people that are fed up, people that are frustrated, people that feel like life has gotten harder and more expensive for the last 4 or 5 years, as it has for most. That struggle gets big enough and swells enough from the bottom that it starts to affect the top. Okay. That's where I think this potential turn is coming. It's going to be everybody struggles, and then it all ultimately affects, the high end demographic. It affects the market ultimately. But we're not there yet. Like, we're not there yet. The market is shrugging off a lot of things. Here we are today. It's like we had a threat of a war last week, and the market was down a little bit. Here we are up, over 1% today. Main Street versus Wall Street. I think this is pretty straightforward. We can all agree that since 2020, it's been K-shaped. If you've been invested in the markets, if you've had assets, you have seen prices of assets go exponentially higher, like way faster, way more than what they really should be. Versus Main Street, you've got about 60 to 70% of Americans living paycheck to paycheck. You've got everyone seemingly unhappy with just stuff is more expensive. I can't think of anything right now in my life that is cheaper than it was 3, 4 years ago. I mean, maybe things have come back to normal, but not really. Like, the new normal is stuff is more expensive. And that's what we're dealing with. So then ultimately you decide, do I need to buy this? Do I want to buy this? Is it justified? Cars are more expensive. Houses are more expensive. Interest rates are high. As we have the most unaffordable housing market we've ever seen, because the average house right now is about 6 times salary, versus what's typically been the historical average has been around 2 times salary. So it's a big difference. Okay. Bulls and bears make money, extremists don't. I'm telling you, if you get caught in this narrative where it's you're just crazy bullish, okay? You're crazy bearish. It doesn't work. I mean, again, if you're going to be right on it, then obviously trade really small and have this really asymmetrical bet. But most of the time, bulls make money in the markets most of the time. Okay. Bears pop up and they can be really violent and aggressive, but you can be a bear and make money. I just think you got to pick your battles very carefully, trade extremely small, and then be right. Maybe once every couple of years. But if you're, perma bear case, perma bull case, I think you miss a lot of trading opportunities. Okay. What's dominating the narrative right now? Everyone's excited about the AI trade. Everyone's excited about the future. Tech has come back in a pretty big way after being beat up aggressively this year, but I think it's hype. I think that the sectors that are leading the world right now, it's not tech. I mean, yes, tech is jumping. Like, Oracle had a huge week last week. AVGO came back in a big way. Mag 7 has responded nicely after the pivot in April. Um, but also, I mean, if you think about this, like, AI is coming for everything. AI is coming for everyone's job. It probably can't be stopped. The only thing that happens is we bottleneck it. It's going to make companies as profitable as they've ever been. And this is what Wall Street's excited about. Okay. Wall Street forecasts earnings to be higher as opposed to a compression. We haven't really seen earnings give back anything. They haven't been revised lower. And until that is the case, I mean, until earnings come down, until earnings look like they're stagnant or going lower, the markets aren't going to fall. Okay. So again, like, the timing of this, it can take months and months and months for something to really roll price over. But it doesn't take, a surprise event could certainly, start this narrative starts faster if all of a sudden we see like an aggressive storyline that, I mean, Israel and Iran attacking each other. It's like, is the U.S. going to get involved? Is this good or bad for geopolitics? I don't know. What does this do to oil? Look, if oil prices surge up to 130 to $150, there's going to be some talks of problems, right? Higher inflation, all of a sudden energy prices go through the roof. It's going to mean something like that. That's just the rate of change of everything. When it happens super fast, it's typically problematic. Our interest rates. Look, the Fed raised interest rates so aggressive in 2022, the market hated it. We had a bear market in 2022. We had a bond market that was in a bear market that dragged equities lower. We had anywhere between 25 and 35% corrections in the S&P and the Nasdaq. But once that was cleansed and ventilated, then the market found its footing, led by large cap again, led by large cap megatech, which is your Mag 7 essentially, and that led us out. And then broader market had a couple of surges in 2023, which led us into a 20 plus bull market, and then 2024 is a continuation of that. And here we are. It's 2025. We had a bit of a ventilation again, but it was for different reasons. But now the market is focused on hype, future, forward thinking, forward guidance, and it's optimistic until earnings change. So if we're really going to see the market roll over and actually have a sustained bear move, it's going to have to be something where earnings are forecasted to be way, way, way lower. Okay. All right. Let's go. Let's keep going. Um, Global yields rising. I think that, with the dollar being down to one of the worst starts in the last 30 plus years, the dollar's down like, 9.5 to 10% from these recent highs. The potential blind spot is global yields rising. It's not so much that they are rising, it's more so that they're rising at the rate that they're rising. So Japanese currencies, Bank of Japan has always been seen as a safe haven currency. There's tons and tons of loans out there in Japanese yen. And what are they doing is they're borrowing the Japanese yen in order to invest in something like US dollars or Japanese yen you borrow and you invest anywhere. Because for years, like a decade plus, you were talking about negative interest rates. You could essentially borrow at negative interest rates and invest in anything and get yields. Okay. That was what 2024's hiccup was from July to August. That was the Japanese yen deleveraging because all of a sudden things were going back because Bank of Japan is one of the only banks right now that's actually raising rates. Okay, this week we have the Fed on Wednesday, which is still going to likely pause. We have the Swiss National Bank on Thursday, which is looking to cut back to zero. The Swiss National Bank is looking to return to zero interest rates, 0%. The Bank of England's likely going to stay at 4.25. So we have central banks that are still cutting. Australia's cut, New Zealand's cut, CAD is cut, Eurozone's cut, Bank of England's cut, US has not touched rates. But everyone knows the Fed is likely going to be cutting. Swiss National Bank has cut rates. Bank of Japan is raising rates. Japanese government yields are pushing 3 to 4%. Okay. This could still be a deleveraging event like we saw last summer. This could still be happening, and maybe it's somewhere on the radar in 2025 that nobody's really talking about. The one way to watch that would be your dollar yen, right? The dollar yen at 140. If we break that 140 floor, we're going to have some severe currency risk. We're going to have some crazy volatility in currencies. That 140 could easily be measured to a move down to 120. So if we get to the charts here before I'm done, I'll show that. 120 would be my target on the dollar yen if we break that 140 floor. If we hold the July to August sell off last year, we're still in that range almost a year later. Okay. So if that range holds, then it's just a typical Japanese yen where nothing really happens. Mind your P's and Q's. Don't think silly on the Japanese yen because we don't have like a big fundamental slide yet. But if that floor breaks at 140 with sustained down move, weaker dollar, stronger yen, I think that could be a major, major risk off move for the currency markets this year. Okay. Mag 7 and mega cap still reign. Look, this is why I trade the indexes. We have proven for the last several years that you don't have to invest in 500 companies. You can literally invest in the top 10 and make money. Now, this year we did have a broadening out. We saw that the markets were all down in March and April. We saw a pretty nice broadening where it's not just Mag 7 leading the way. Mag 7 was part of the pain earlier this year in the rotation. But if it wasn't for solid, consistent Mag 7, I don't think this bull market would be nearly as aggressive as it has been since the bottom on April 9th. Okay. Mag 7 was one of the beat up sectors. So, I mean, there's literally a ticker Mags that was down 33% from peak to trough. Okay. And it's rallied back in a pretty big way. We know that, yes, the growth of a Mag 7 company might be stalling, but the CapEx spending, the amount of money that they have to invest in the future and this arms race for AI, Mag 7 is definitely leading the charge. And the question now is, are smaller companies able to match that or compete with that? And some say you can't because you're just going to be gobbled up by basically multinationals that are just too big, right? But at the same time, like if this AI thing is really going to allow companies at smaller scale to compete, this is where the Russell could be a great catch-up trade once again. When the Russell still has double digits to get to all-time highs, while the S&P is only 1.3% from all-time highs, 1.2% from all-time highs. The Nasdaq is, under 2% from all-time highs. The Russell still has like 12 to 13, 14% to get back to all-time highs. So I still think the Russell needs that little bit of extra juice with the Fed cutting rates, maybe later this year, September, December, if that helps the market. But I think we also have to see bond yields cooperate. That's the one thing there's a really weird correlation last year is the Fed cut rates by 100 basis points, and the bond yields went up by 100 basis points instead of going down like they have for 40 years. They went up because the bond market. In fact, I don't want to slaughter the saying, but basically, it has something to do with like the government's still going to spend money until the bond market takes away the keys. That's kind of the saying. I could be paraphrasing, but that's along the lines. Like the bond market, even though, like personally, I don't want to have a lot of bonds in my portfolio. I'm not a 60-40 guy. I think that is a terrible allocation. I'd rather trade options around my core positions and generate my alpha that way, as opposed to having a 60-40 mix to lower volatility. But why would I want to hold something that's potentially in a 5-year drawdown? I mean, we've had a solid 4-year drawdown outside of maybe the melt up in 2023 when the bond market ripped October to November 2023. It finished positive for the year, but it's been in like a 4-year drawdown. And that was like a just a squeeze, and it immediately faded back to fresh lows. So my point is, like, I don't like bonds. I think inevitably bonds continue to stay maybe stable, but all it takes is one failed bond auction after another. All it takes is discouragement and loss of confidence in the U.S. as like a safe haven. And you never know if this is going to happen. I think, look, if the U.S. catches a cold, the world gets the flu. I really believe that. We saw that in April. You can see how systemically tied everything is. So if the US is not stable, the whole world's going to struggle. If the US is not bullish, the whole world's going to struggle. If the US is bearish, we will drag everybody with us, whether you like it or not. You can say, like, oh, the US has to perform well for the world to do well. And this year it's very evident that the world is trying to repatriate. The world is trying to say, look, if everything is so expensive with 22 times earnings, the S&P, maybe our money's treated better in the Euro stocks. Maybe our money's treated better in China. Maybe our money's treated better in India. Maybe our money's treated better in emerging markets. Anything, anywhere else that's not expensive, that's where money's going. Why? Because if something positive happens in those other markets, there's a lot of upside there. If something happens positive in our market, it's got to be really positive. It's got to be almost perfect for us to still sustain 22 times earnings, 23 times earnings. And because historically, you look at what these have done, higher earnings, like higher priced earnings in the S&P, typically mean that we're overpriced, we're overvalued, and things tend to correct. So anyway, global melt up. Last point here before I switch slides. This is probably my biggest risk in 2025, is that we don't go down at all, because fiscal policy is expanding. And it's not just in the US. Look, we have a government that can't stop spending. We have a government that clearly will not detox. And now we have other countries that see what we've been doing. And I mean, think about China as an example. China has been this like sleeping dragon since COVID. They were one of the most extreme lockdowns since 2020. They have put very little capital back into the country. But this last fall, so 2024's fall, they started to add basically bottoms in their property markets. They started to add bottoms into their capital markets. And they are trying to support property markets and support capital markets. And the Eurozone this year with defense spending, and also trying to get things that are aligned with this less reliance on the US. A lot of Euro stocks, a lot of Euro offices that have held US stocks for many, many years are now starting to rotate out and going back into their own. The best performing assets this year, you'd be very surprised. The acronym is PIGS: Portugal, Italy, Spain, Greece. Terrible performing sovereign debt crisis type countries. Their ETFs are killing it this year. And they have been V bottom from April into straight up all-time highs again. And so you look at that, it's like, well, should I be trading that? Should I be chasing that? I'm not chasing that stuff. They're way less liquid, and those are actually garbage countries to be investing in. But because they are so cheap, just a little bit of repatriation goes a long way. And so the Euro stocks have done extremely well this year, and they are outpacing the US. We have a lot of non-US based investments that are up double digits and outperforming the S&P and outperforming the Nasdaq. But like I said, I still think that the world will benefit from a stable US. If the US goes up, everybody wins. If the US is stable, non-US can still win. If the US goes down, we're dragging everybody with us. Okay? All right. Surviving in 2025, risk management, the most important thing. Time in the market, extremely important. That's one of the biggest assets, with just giving yourself some time to survive. Look, if you're a new trader, nobody's going to figure this out in a matter of months. Look, you can follow Nick's trades, you can follow my trades. I know that if you have no idea like how to trade Forex, if you have no idea how to trade options, if you have no idea what you're doing, look, trade small, demo trade, get the process, get comfortable navigating a broker platform. Those are basic prerequisites, but just don't do anything silly. Don't do anything stupid. I mean, right now it's like we need instant gratification, instant profits. We need to make 10x returns. We need to celebrate it on Twitter. It's all for show. I mean, I've been doing this for a long, long time. This is now 25 years into the markets. Okay. My biggest gain for a year was like 150%. And that was about when I had like $20,000. I made a lot of money, and I had some money tied to it in a copier service, and I turned like 20 grand to like 150K over like a 2-year window. That was like one of my biggest runs. From that point, it's been preservation capital. Like I just heard this last night on a podcast. It was some paraphrase quote from Charlie Munger where the first 100K is very difficult to get to, but once you're there, it opens up a lot of doors. Because at a compounding rate of 100K making 10% a year, you can do the math on that. You see that it grows a lot faster, right? Like if you've got $1,000 to invest, okay, fine. But look how long that takes. Here's a fun story. This Invest America plan that they're going to give every newborn $1,000. Okay, if that's all you did was your kid, let's say I have a baby this year and I get $1,000. This isn't done yet. This is still in the works. This has to be part of this probably tax bill that might pass. Probably will pass. But let's say every newborn kid in 2025 gets $1,000. How many parents? and I hope that everybody does it for the sake of your kids. But for every parent that gets $1,000, if you do invest $1,000 in the market and it annualizes about 8% a year, which is the historical norm of the S&P, your kid goes from born to 18 years old, and you're sitting on about $10,000 by the time they're 18. I'm sorry, but $1,000 one time is not going to change anybody's life. So the plan is Invest America, start the trading account. If at the very least the parent could do $1,000 a year for their kid, that doesn't take a lot of money, but you'll see like exponential growth. But it's time in the market and it's consistency through the ebbs and flows, as opposed to we got to trade every bull market, every bear market. We got to get every top and bottom. No, you don't, right? If the market's pulling back, be prepared to buy more. If the market's going up, ride it. It's that easy, and it's not like the market's going to go up every single year forever. We're going to have pullbacks. We might have a pullback this year. We might pull back even further. I have no idea. But if we melt up to 6,500, if we melt up to 7,000, if you look out 10 years, we're probably going to be at 10,000 on the S&P, right? So if we go from 6,000 down to 5,000 again, the question is, in 10 years, are we still going to get to 10,000? Because I would imagine we could. It's just don't lose everything when we have a 20, 30% correction. Don't lose everything when we have a 20, 30, 40%. It's not easy to survive. But the point is, man, risk management is the most important thing. And time to stay in these markets will keep you from, blowing everything up. So I just think it's a funny initiative to see like $1,000, like it's this big deal. How's it not inflationary, right? We gave everyone checks in 2020 for like $500, and the whole world lost their mind on inflation. So how's $1,000 for every newborn, every family going to be non-inflationary? I have no idea. But when you look at the compounding numbers, if it's just a one-time thing and the parents don't invest in those kids, your kid has nothing to show for it. It's $250,000 to raise a child, roughly. It's probably going to get more expensive. You want to send a kid to college, it's double. So anyway, diversification, spread across sectors, asset classes, geographies, meaning it's not just a U.S. trade. Like I like the U.S. markets because they're super liquid and we have some of the best performing stocks in the world. We have some of the best markets in the world. Believe me, the US markets are far more liquid than everything else out there. Okay. I am mostly US based, but my diversification this year is I have ETFs that are non US based entirely. So it's Europe and it's Asia. I trade in the Japanese yen. I'm trading oil. I'm trading uranium. I'm trading gold and silver and Bitcoin, which are just general assets. Okay. Um, and on top of that, between sectors, US, non US, between, the trade sizes, it's tiny exposure. I mean, basically, I could summarize my pie chart as I have equities, I have gold, silver, I have Bitcoin, and I have other. The other would be Japanese yen, the other would be uranium, the other would be energy, the other would be like hedges and diversified assets. But a lot of these trades are very small that if I lost on one portion, if like one part of my pie failed, I'd have it hopefully picked up by the others to at least weather the storm, eliminate a lot of volatility, and not lose a ton of money. Does that make sense? Okay. Um, Core income strategies. There's a lot of ways to do this. I mean, the boring stuff that I've been doing the last probably month has been I have shares in the SPY, I have shares in the IWM, I have shares in the Qs, I have shares in Tesla, I have shares in MicroStrategy. That's 5 core positions. Okay. I trade a lot of options around them, and all that is I'll have some downside protection and I'll sell calls. and I'll sell calls. And I do it every typically 1 to 2 weeks. If I can get enough money to roll it, I will roll it. It's anywhere between like 2 to 4 weeks. So every 2 weeks to 4 weeks, I'm generating for my portfolio, which is around $3.5 million right now. Um, Probably helps me generate, let's just say 2 weeks out, probably close to like 10 grand every couple of weeks. And the markets don't have to go anywhere. If they go sideways, I can still generate that return. If they go up, I can still generate that return. I'm just losing a little bit of the price appreciation. But if I just keep selling, 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 and things go sideways, like that's fine. If things go down, I'm fine. Um, I've turned it into like a very boring income strategy because I'm not chasing this market to these all-time highs. I think that we can get there, but after look, the courage to buy and participate through March and April was how I made a lot of money this year. Okay, it was having dry powder. It was being cautiously bullish going into this year and be prepared for the downside. And I didn't love it. I mean, I don't think anybody loved it. Watching Liberation Day on April 2nd to April 7th's bottom, nobody loved the fact that the market dropped about 8 to 10% in 3 trading days. Nobody loved that. That's not easy for anybody because that rate of change is so severe that it just leaves people panicking. And we had that negative sentiment hurt so bad that 11 straight weeks. And the AAII sentiment survey reflected that people are scared and there's so much uncertainty that the bears are, 50+% of the AAII sentiment was bearish. And they're dead wrong and they're clearly on the wrong side of the trade because once we pivoted April 9th, it was a melt up for the last, almost 2 months. But the courage to buy during that downturn paid out very well. But here we are after a big melt up, running through a lot of resistance levels, getting overbought, seeing some rising wedges, just getting back to the all-time highs. I mean, the pain trade is more upside because everyone is still like, is it going to pull back? Should it pull back? Yeah, it should, but it might not. So I think a pullback to like 5,900, 5,800, 5,700 might be all we get. And this market goes into like a global melt up mode because the US wants to stay stable and the world is going to benefit from a stable US. And possibly if the US can grow through this, then yes, US grows, world grows, right? But what's interesting this year is a lot of money is non US. A lot of money has been migrated into non US because the US is expensive. We do have the most liquid and best markets in the world, but it is expensive. Okay. Um, so there's all sorts. I mean, if you've looked at the ETF space lately, there are so many tools to use. It's staggering how many ETFs are created that you can just say, look, I can buy the SPY that just sells covered calls. That's an ETF, and it performs like absolute trash in a bull market, but it does great in a bear market. Granted, the price is down, but you can generate 8 to 10% a year on just selling covered calls. Um, but there's ETFs that do that for you now. There's funds that manage that for you now. So even if you're a basic novice trader, there are tools out there that can allow you to, kind of dial up or dial down your risk profile. I just keep going back to don't take too big a risk. Don't put everything in one trade. Um, and just trade small. I mean, survive long enough. And like this market gives so many opportunities to be profitable, but you got to be around to get it. You got to be around to take advantage of it because too many traders are just going for instant gratification and going for the fast money. And as enticing as it is, I mean, look, I would love to make hundreds of thousands of dollars a day, but I know that to make that, that's that much more risk. And if I'm wrong, I don't want to have that type of risk. So my job, as somebody that manages accounts, is I'm looking at the highest risk adjusted returns that I can make. So on average, my goal is to try to keep my drawdowns under 10% and my gains hopefully double or triple. And fortunately, the last 5, 6, 7 years, especially with incorporating a lot more heavy options trading, I've been able to do that. Index by the dip. So I think we're going to get a dip. I really do. I think that pullback to like 59, 58, 57, that would be areas where I'm looking to scale back in. I think we position for all-time highs again. I still want to have the asymmetry downside. I still want to have insurance out to the end of the year. If we roll into 2020, let's just say we're at all-time highs by the end of the year. I'm still going to roll into 2026 with very cheap hedges that could pay me 20 to 1, 30 to 1, 40 to 1 just in case I need it, right? Um, I don't trust the sustainability of a 22 times price earnings. I've got a slide that'll explain this, and I'll go into that in a little bit. But right now it's like buy the dip has been rewarding the retail crowd very, very well. The one thing I think is shockingly shockingly obvious in 2025 is the retail crowd was rewarded very well in 2025 thus far. Because what did the retail crowd do? Apparently, the retail crowd was the only group that's buying, and institutions sat on the sidelines, potentially positioned bearish. But just last month, like we had some major inflows in hedge funds. Okay, well they're playing catch up because hedge funds aren't mandated to do anything. They can basically have blackout periods and not tell anybody anything, and just they'll send you your statement every quarter. um, but if you have a mutual fund, I mean, you have to have like a mandate allocation. You've got to give back as much of the gains to the investors, but a lot of it's so passive, and a lot of it is so like basic stuff that you don't realize how it looks sophisticated on paper, but it's actually very simple stuff. Like an entire fund exists to just be 60/40, which means I own 60% of the SPY and 40% TLT, and that's my investment. And people pay for that, you know? But buy the dip, it's like, look, the retail crowd's been rewarded for buying the dip. And if you look back 10, 15, 20 years, yes, we've had some windows where buying the dip could be painful, like 2022 when the market was down 35% from peak to trough. Buying the dip was painful. But we also had 10 plus percent down, up, 10 plus percent down, up, 15% down, up. Okay, so you dollar cost average, dollar cost average, dollar cost average. And guess what? Once we got through the rally, the end of 2022 was a Q4 rally, 2023 was all bull market, and we finally eclipsed that 2-year drawdown after the early part of 2024. So you did have a 2-year drawdown. But if you dollar cost average, dollar cost average, dollar cost average, guess what happens? You made money, you made money, you made money as we got to all-time highs, and now we are 20 plus percent higher. You're making more money. You got to survive. You got to have some dry powder to buy those dips. Okay. All right. The way I plan on buying the dip for 2025 is I'm going to leave a massive wide margin for error. So if we get a pullback to, let's say, 5,900, 5,800, I'm going to position option trades where I want my bottom to be S&P 4,800. I'm going to be bottom on Qs, or bottom on Nasdaq is going to be my Qs at 400. Okay. I'm looking back at like April lows, and like I'm willing to own shares of SPY, Qs, Russell, Dow at April lows, but I'm going to position for them because I'm going to give myself like it's income. I'll do it on all my accounts. And maybe the dip from 50 goes to 62, 63, 6,400. And I'll participate in that a little bit. But for me, it's the income of taking, let's say 30 or 40 trades at bottoms with having a wide margin for error, you know? So, I mean, to me, it's like that's safer money, give myself a lot of room for error and still make the income in addition to participating in the upside. Okay. Favorite assets in 2025. I think if you're doing a scan nowadays, I mean, I use a pretty simple thing. I mean, when I scan for the markets fundamentally, I'm looking for companies that have cash, don't have high debt, and what's their forward guidance and earnings per share. If it's positive, profitable, without a lot of debt, that to me tells me that the company has runway to be profitable and successful. Um, if obviously we're not overpriced and overvalued, if we don't have crazy high price to earnings, then it makes it a little bit better. I think value investors have been performing like garbage for the last 10 years because they're waiting for, oil to finally step up and non-tech assets to step up. It's just, look, you got to acknowledge like we are a tech-based economy and a service-based economy. If people are willing to spend money on services, great. If people are willing to invest, which mega is investing in tech because that's the fastest growing and the fastest ripping and the highest profit margin sector that the world has ever known is just high value tech, right? Um, man, I think there's a lot of ways to get the job done, but I want to see on paper. I don't want a stock that can't make money. This is what happened in 2000. You had hundreds and hundreds and hundreds of companies that literally couldn't make money. They didn't make money, but their valuations were sky high because it was just pure tech euphoria. Okay. Are we there in 2025? No, not really. But there's a big difference between companies that, I mean, when when Nvidia can make what $40 billion a quarter, and a company that is negative. There's a big difference. And I don't care that Nvidia is, it's priced out, it's expensive, and high, I get it. But if at least on paper it's making money every quarter, on the next like 6 to 12 projections is expected to make more money and maintain profit margins, that to me is something worth investing in, as opposed to, well, this stock is garbage right now on paper, but I think it could be. It's like I'm not invested in what could be, you know. Um, I'm really comfortable trading like what is. If we go in, like especially if we go into a downturn, or we go into like, look, is anybody going to invest in non-performing companies? If a company doesn't have the runway or cash to survive, I don't want to be in that stock, right? So this is why I trade the indexes a lot. I trade boring old ETFs like the SPY, the Qs. I trade SPX, NDX. I trade futures. I mean, stick the indexes. Indexes. I don't have to be a stock picker. I can reduce volatility probably by 50+%, if not more, by avoiding a single stock play that blows up. Right? Here's an example. I've got a buddy of mine that has traded for probably close to 8 years now, probably 8 years. Um, he dabbled in penny stocks. He turns about $100,000 into like $4 million over that, like I'll say 5 or 6 year window. Things were great. Um, I'm talking probably, let's say, 2017, 18, 19, made a lot of money, survived in 2020, melt up in 2020, 2021. So we had about a 5 or 6 year window where like he almost did nothing wrong. 2022, he started losing money. 2023, it's not been any better. 2024 hasn't been any better. 2025 hasn't been any better. Like, so long story short, $100,000 turns into over $4 million. $4 million is now less than $500,000. That's 6 or 7 years of a career in trading that's now showing basically nothing for it. That's not fun, you know. Unfortunately, I mean, it's a one trick pony system. It's like I still trade penny stocks. Why? You know, when a stock goes to zero, or a stock you have to put 1,000 little bets on and hope that one pays out, and those stocks just magically get delisted, you're just losing across the board, and you have no control over how those things move. So I'm going to trade something that's big and liquid and is likely designed to go up. The S&P 54, 55, 56% of the time is designed to intrinsically go higher. And it can benefit from the broader market. It can benefit from this tiny little top 10 market. We have companies that are so big now at $1 trillion+ market cap, they alone can get the market higher. It's not great to have a narrow market like that, but if you trade the top 10% of the S&P, you trade the top 20% of the S&P, it performs a lot better than the bottom 90% and has been for a while now. So anyway, I want to have quality companies. It's that simple. If I'm doing individual stocks, I want quality companies, or I want crazy high premiums if I'm going to take on the risk of those trades. Indexes. I trade a lot of indexes. S&P is my favorite. Dow is low volatility. Russell's a bit more speculative. Nasdaq is high flying, but man, Nasdaq is the best performing asset the last 30+ years. As far as indexes go, there's no comparison between S&P the last 30+ years to the Nasdaq. So, love or hate Bernie Madoff, the guy did create the Nasdaq in electric trading, and electronic trading has been a game changer. And tech, the top 100 tech companies, we are a tech-based industry. It is never more apparent than looking at the Qs and how they perform. Yes, they're more volatile, right? All right. Hedging is short-term plays. Now 0 DTE, you can hedge every day if you want to. You can hold a portfolio long bias and you can hedge every single day to protect your downside. That's okay. But you'll just have a bunch of paper cuts that don't make money, right? So hedging to me is, I like to hedge out typically 90 days, if not more. So I'll do like a quarterly hedge, a half a year hedge, or a year hedge. And they're cheap. I don't like to spend more than 0.5%. But the asymmetry is they offer me, sometimes 10 to 1, 20 to 1 or better. But I trade index futures for a lot of hedging. Gold and silver. Silver's poor man's gold, but silver's, to me, like I've been talking about this since 2024. I mean, I like silver because it's something I can see on the chart. Having 35 to 40+% more upside to measure the all-time highs. To me, I'm excited about silver maybe getting to all-time highs again. You look at a silver chart in 2011, you look at a silver chart in 1980, the highs are up towards $50. Okay. So this recent break at 35, going from 35 to 40, or I'm sorry, 35 to $50, I like that I can measure that. I like that I can see that on a chart. You go to gold, gold's had a great bull for the last couple of years, right? I think gold is clearly seen as like a bit non-dollar play. Bitcoin is wedging its way in there as well, but gold it's a great asset. It's always been a great asset. The 60/40 portfolio, having equities and bonds, if you replace your 40% allocation of bonds with gold, it performs better over the last 40, 50 years. And right now, I think gold is really being taken in as a better asset store value than the U.S. bond market. And gold's been in a great bull market the last couple of years, and likely, geopolitical risks and escalating tensions, like gold can still maintain bid. Okay, Bitcoin. I mean, I've been dabbling in Bitcoin since 2016. I've been happy to see that, like, my little tiny bets with like asymmetry and upside, and like, look, I'll put 1% of my account into Bitcoin. Now it's more like, I mean, personally, I have about a 15% allocation to Bitcoin. Personally, clients, I have about 3 to 5%. Look, I can make 3 to 5%. If I'm dead wrong and Bitcoin goes to zero, I can make 3 to 5% back in my account. Okay, but that 3 to 5% that could potentially be 10x to 20x returns. Why would I not take that trade? And on top of that, like, what is gaining more mainstream attention is that Bitcoin is serving as some type of alternative to this fiat system. So if we are going to continue to print our way to oblivion and devalue and debase our currencies across the globe at 120 plus percent GDP that continues to rise and opposite of the 6 to 8% deficit every single year, Bitcoin is that potential hedge. And I know that's very extreme, but that's where the bigger adoption is coming. It's like, even if we ran a parallel system of, you can have paper money that runs like a checking account, but you can have something that actually appreciates on an annual basis 20, 30, 40%. And that can run in a savings account. That's what I look at Bitcoin as. That's what I look at gold and silver as. Like, they're non-related, right? Like, if the dollar gets weaker, they should go up. That's a good thing. If we print money into oblivion and debase, but they go up, things in terms of gold, things in terms of silver, things in terms of Bitcoin are cheaper. Okay. The house that I just bought 2 weeks ago, that I closed in this house. Okay. If I bought this house, 10 years ago with Bitcoin, it would have been however many Bitcoin. If I bought it today in Bitcoin, it would be like, I don't know, 5, 6 Bitcoin, 4 or 5 Bitcoin versus 20, 30, 40, 50 Bitcoin, 10 years ago. So the price of Bitcoin has gone up. The price of gold has gone up. Things have gotten cheaper in those terms. But in dollar terms, this house is going to go up $100,000 in the next 5 or 10 years. How? It's not worth anymore. Like, square footage wise, it shouldn't be worth more. And that's where this funny money market is right now. It's like, people bought houses during COVID at sub 3% interest rates, and those houses are now 2 to 3 times the price on paper. They're really not worth that much. And in dollar terms, it's like everything's more expensive, but your dollar goes less, like less far than it did, right? So anyway, I like things like they're appreciating. Bitcoin's gone up in value, gold and silver's gone up in value, and things get cheaper in those assets. Okay, favorite strategies of 2025. Look, if you take advantage of getting your hands in the Edge Finder, grabbing the combo with the Pulver alerts, I have a practical options course that gives you a lot of these things for free. It's included with the Pulver alerts. Ratio spreads, some of my favorite trades for stocks that I want to own. To me, it's a bit more of it's a tweak on the cash secured put. It's a tweak on the naked put. It's the tweak on the wheel strategy that's very common. Ratio spread's one of my favorites because I get a little bit of a profit bump if price does go down for assignment, and I also generally take the trades with high income or high probability of income. Debit spreads. Look, I have a strategy video. If you're interested, you can hit the team up on Discord. Ask about like Chris Pulver's debit spread video. Ask Chris Pulver about credit spread video. I have a strategy session that I did on YouTube for like, it's 90-minute session. If I can get anybody to just open their eyes on trading the market directionally, you can trade up, down, sideways. I just want to teach you the difference between buying a call, creating a spread for a debit, or creating a spread for a credit, understanding the consequences, the lines in the sand of, if I take this trade, where does price have to be for me to make money? If I take this trade, where does price have to be for me to have risk or reward? Okay. It's just simple understanding and awareness of, if I take this trade, what has to happen? And my favorite thing about trading options is all it is time and price. That is it. Time and price. So all the wick highs and the wick lows and all the tests of levels and all the sweeps of highs and liquidity grabs and accumulation and distribution and all the fancy things with supply and demand. All that price action stuff is important. But to me, what's nice is my trade only has to rely on time and a strike price. That's it. So I have an exact line, and I don't care if price hits it 1,000 times. If my trade is still running and not expired, my trade is valid. I don't get stopped out. I have my risk defined from day one. The market could literally go to zero or go to infinity, and I'm only going to gain or lose what I put on the trade. That to me is awesome. I could build a lot of forgiving strategies with wide margins for error and also take very defined risk, right? Which I think for most retail traders would help them a ton, because most retail traders, unfortunately, when they lose way bigger, right? They lose way, way, way bigger. That's the problem that I see. Okay, so define that risk. Dollar cost averaging, like I said, 2022, we're down 10%, buy more. We're down 20%, buy more. We're down 30%, buy more. I know it's painful to do that, but it's allocating, right? In the next probably 12 to 24 months, I do think we're going to have another 20+% pullback, probably more, right? And let's say that we go down 40% from all-time highs, wherever that is, and whatever the cause is, I don't know, but I want to make sure that I have dry powder to take advantage of it. Because again, if this is my watermark, buy in, buy in, buy in, buy in, and we ultimately get back to highs, all of that investment pays you and helps you compound where you weather the storm, you survive the drawdown, you get back to those highs again, and that investment pays off. Dollar cost averaging doesn't have to be huge, doesn't have to be complicated, but indexes at, I'm not talking about every 1% I buy the index. That's ridiculous. Every 10% I buy the index, because that's a great pullback, right? Every 5%, okay, fine. Maybe a bit more aggressive, trade smaller. Every 10, every 20, every 30, every 40, back the truck up and allocate. If we have a 40 to 50% pullback in the markets, I will probably be 75 to 80% invested at that point. Because to me, it's like all it has to do is get back to the all-time highs. And it's time. But if it gets back to all-time highs, that is compounding gains. That is far easier than trying to speculate on little day trades. The big basket climbs back to those highs. Collar trades, covered call trades. I talk about this with a lot of core positions. I sell covered calls to generate income. If I'm really worried about the downside, I trade a collar trade, which is I sell a call above price so I can still get appreciation and some credit, and I buy a put below price for protection. If I do a collar trade, I usually go out 30 to 60 days, and I rotate that collar and I keep going out. So if I always want downside protection, i.e. MicroStrategy, right? That's a high flying stock with high volatility. And if it's basically double leveraged Bitcoin, if MicroStrategy were to dump to $200, I want to make sure I can ride that put lower and lower my cost basis. But if MicroStrategy goes up to all-time highs, it's like, all right, well, I'll get it called away. I still make money and I get a crazy premium for selling calls. So a collar trade is a best of both worlds for me, which is I can protect the downside and I can still let price appreciate and give me the gain that I want, and I can still rotate it. Okay. This is one of the most important charts here for me for this presentation. Is we are here. Can you see me? Yeah, I can see it on the screen. You can see me like hovering around with this little blue dot, right? This is where we are right now. We're at 21 to 22 times earnings on the S&P. Type in where so you can see this. Okay. The reason I want to bring this up is this is the historical returns of the S&P. Okay. And these are at like 10 to 14 times earnings. Okay. That would be a crazy value. If we were at 10 to 14 times earnings, I would be way more optimistic about loading in to the S&P. But this little correction that we saw for a 20% correction in 2025, that pulled us back to around 17. So we went around here, like 16, 17. Now you can see that they're mostly sprinkled of returns to the upside. But when we were back to 21, 22, 1 year out to 10 years out, you can see that these returns are very lackluster. Like from today, 10 years out, annualized, you're talking maybe a plus or minus 5%. So we could go down 5%, we could go up 5%, and that might be where we are at. So can you imagine for a second that your strategy of investing in the S&P 500 or the Nasdaq or whatever it is only going to make you about 5% a year if you just held the basket? That's going to suck. That's not fun. Okay? So my point is, if you understand that, but like this is why Nick said it, cautiously bullish. I'm cautiously bullish for this exact reason. We have a high priced market. The Buffett indicator of, stock price valuation over GDP, it's like 211%. It's crazy high value, which means it's expensive. I still think we have the most liquid market. I still think we have the best market in the world, but man, it is not a discount. It's not a bargain. Okay. Now, can we run to 25, 26, 27 times earnings? Yep, we can, which is why this isn't why I'm calling the top. But it just shows you, like, historically over a 10-year run, returns going forward are not great, which is why I'd love to see some dips and pullbacks. So we have some positives. Yes, we have some positives. I mean, this is since 1985. There's a lot of, it's 40 years. right? There's a lot of numbers here. But between the upside and the downside, I mean, this is why the uncertainty is as high as it's ever been because nobody knows. And we're historically like high valuations and the returns are pretty much lackluster. Okay. Thriving in 2025, track your favorite assets. It doesn't have to be complicated. Look, if you see my portfolio, I trade a ton of stuff from A to Z. There's a lot going on in my portfolio, but also I have, a bunch of accounts that I'm looking after and they're all individually managed. So I've got to pick and choose whether it's an IRA account or a margin account. People need different things that I trade for. So I understand that I've got to be a little bit more, conservative for some and more aggressive for others. But I try not to make it where it's like I can't handle this stuff. It's like I A to Z prune my portfolio multiple times a week. I mean, from opening closing bell, I am here in front of my charts. So I've got the time to go through, find good trades, you know, sell options or generate my trades for speculation, for growth, for income. Um, and I do it on what I think is reliable and liquid, right? Um, the names your favorite names, your household names you want to trade, stay with them, modify them. If you own the shares, consider trading some options around them to lower your cost basis. Consider having some downside protection. Use them as a tool. Options is a tool, in my opinion, to improve your cost basis. Okay, your favorite strategies. Look, like I said, talk to the team, grab the Pulver alerts, get my practical options bonus course, and ask about the strategy session on long options and spreads. And I'll make sure you have that. If that doesn't like at least open some eyes to like, oh my gosh, that's really easy. Like option trading could be easy. Some of my favorite strategies are so simple and I just do lots of them. Like I think I'm at like 19,000 trades for the year so far. It's a lot of trades. Okay. But I don't do what's hard. I don't do what's like, man, I got to rack. It's like second nature. I can rattle off trades, every day, go through the whole portfolio, clone all these trades, and it's 80 trades today. Not that hard, right? But I don't chase anything. Like you want to share, Carvana, you want to share Palantir, you want to share AVGO, you want to share Oracle. It's like I don't care about a stock that's up 20% in a day. I really don't because either I traded it before the setup or I'm not going to chase it after the fact. That to me is the dumbest trade ever. So I'm not that excited. Like Palantir is great. It's an S&P 500. It's one of the best performing stocks in 2024. Awesome. You want to know where I want to own it? $40. It's way below current price, but that's where I'm saying I want to own it. Okay. And if I don't get assigned at $40, I just make income at 100 and some dollars per share. I don't care, but I can still make money on it without having to sit here and chase, a high flying, crazy, volatile. Maybe I don't want to deal with it. I don't want the volatility in my portfolio. Okay. Steady risk, no over leveraging. Time is your friend. I'm telling you, survival in this market is greater than getting a big trade right because the big trade, maybe it pays out, let's say, 10% of the time. That's 90% of the trades you're going to lose. And that's really frustrating. And unfortunately, all you see online from charlatans and, grifters and snake oil salesmen is you see one trade that showed, thousands of percent gain. It's like, but show me your real portfolio, right? Show me what you've been doing to have that one trade that paid out and then show me, I don't know, maybe it's paper money. Maybe it's not even real, right? I mean, I don't have hero trades. Last year, you know what my hero trade was? It's not even a hero trade. It was MO. It's a dividend stock that pays 7% that happened to go up 20% last year. That was one of my best trades. It's so boring, but I made a ton of money on that last year. It was not a hero trade. I just allocated in for the intention of getting a dividend. Getting away from it's okay. So if this stock can offer a 7% dividend versus a 3.5%, 4% bond, why would I not? I'll trade this. And the price went up. So instead of prices going down with a crappy dividend, I had a stock that went up with a better dividend. It was best of both worlds. But keep size consistent, manageable. I don't take a lot of risk. A lot of my trades, every single trade for 19,000 plus trades, a lot of them are fractions of 1%. It may sound boring. Look, maybe none of this resonates because like, this Chris guy doesn't take any risk. I mean, I do take risk. I've got a lot of risk in the market, you know, but it's risk that I can handle. It's risk that I can handle emotionally. If this market takes a 20, 30% correction, I'll be okay. It's not going to be fun, but I'll be okay. What did I say back in March and April when the market was dumping? It's not going to be fun to trade through this, but we'll figure it out. Right. And I don't know if the market's going back up to 62, 6,300 or getting all-time highs again and melting up where it's a bubble, or we're going to drop back 300 or 400 points. I don't know. And nobody else does either. Right. Your prediction of the future is no better than anybody else. So we know nothing about the future. We think we want. I mean, there's good technicals, there's ways to kind of forecast, but it still comes back to risk management. Okay. This is what I'd like to see. If we get 3, 5+% dips and pullbacks, I'm going to trade them as if I have room for a 15 to 20% correction. Okay. I think minor pullbacks will be noisy. I think we've got some good opportunities on the horizon. I think the market does roll back to like 5,900, 5,800 here in the next maybe 30 to 60 days. I'm going to look at that an opportunity to align and add some more income trades and also participate in some dips. Keep grinding, keep grinding, keep grinding, keep trading, be consistent, small risk. Time is your friend. Survive this market. Do yourself a favor and survive this market, right? How about this? Survive this market through Trump. When he is no longer president in 2028, survive this market. It's probably, the market's probably going to go higher, but we could also have so much of a bipolar market where it's like we could go up 20, 30, 40% and Trump can, walk out with this legacy of like, look what I did. I'm the greatest president in the world. Or the whole market and world at him coming into office at a 22 times the earnings could be garbage returns that we're going to have to figure out how to trade and navigate with just lots of volatility and lots of ups and downs that nobody can really navigate, right? It's just so much unpredictability. I still want to make money this year. I still want to make money next year. I still want to make money the year after that. And I never know if the market's always a sure thing. The only time I felt sure in the last 25 years of my career would have been maybe a bit of the bottom in 2009 when I knew way less than I knew now. And the bottom in COVID, I was like, I looked at 10-year discounts on pretty much everything. And I felt like that was one of the safest times to buy. And it's nuts because the whole world was ending, right? Everyone thought nobody's going to go outside ever again. We're never going to see each other ever again. The whole market's going to go down. The financial market, the world stopped. But it offered up 10-year discounts. I was going to buy it. And that was one of the greatest, like 12 to 24 months run I've ever had in anything. But that was as certain as you can get. Now, I'm not certain. This market might melt up. It might fall 5, 10, 20%. I have no idea. But I'm going to grind and I'm going to figure it out. Okay? All right. I think that's my last slide for you. Any questions? So let me leave this. Before I go, I do have another session to jump into here. So I appreciate everyone being here today. This has been a lot of fun. I know there's a lot to take in. This is a lot of information I'm throwing at you. But I will say this, your Edge Finder, okay, get your 45% discount, okay, Pulver alerts to go with it, and ask for Chris's practical options bonus, and ask for Chris's strategy session. Okay, and all it is, it's long options and spreads. I mean, you hear me talk about options. You see a lot of the Pulver alerts are options based. I trade futures options, index options, stock options. I do trade Forex, but passively. I'm a passive Forex investor. The most consistency I've had in Forex has been dollar cost averaging, big levels, big time frames. I don't do much like swing trading, short-term scalping. I don't. I'm over that. I ran a fund. The only way I made money was position trading consistently with way less risk and drawdown. Okay. But options, it's risk defined, it's time and strike. That's all it is. That's it. There's no funny business around those highs and lows. It's either above price or below price for me to make money, and my risk is predetermined. I can't lose more than what I put in the trade. So everyone that knows the importance of risk management, this is the best way to do it. So ask for the bonus. The practical options course is 4 hours long. It's just a bunch of little modules. Ask Fro the strategy session. Ask for my strategy session. It's about 90 minutes. And I just do the math. Here's the trade. Here's where price has to go for me to make money. Here's my risk. Price can go to infinity or zero. Here's my risk. Here's my reward. Good stuff. Okay. All right. I'll let you go. Thanks a lot for being with us today. And this is going to be a great week. There's a lot of news this week. We got a VIX expiration this week. We got the Fed this week. We've got the quarterly expirations coming at the end of the month, which is not next week, but the Monday on the 30th. Juneteenth on Thursday, the markets are closed. So it could be an interesting week with a little bit of a holiday disruption. Plus the Fed on Wednesday, maybe Friday gets a little bit more exciting. So keep an eye on things. All right, I'll let you go. Have a good day. We'll see you this week. Thanks. Bye.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.